The truth is, most people lose money in crypto. Not because they want to, but because they don't know the rules of the game. And in many cases, it's simply because they've never actually learned how to play it properly. I've watched my first 5 figures turn into 6, and then back to 5 again. I've made every mistake you can think of. But after spending half a decade full-time in this space, through bull runs, crashes, rug pulls, and black swan events, I've built a system that actually works and one that's allowed me to make a living. So this isn't a hype video. This is a guide on how to win at the game of crypto, even if you're starting from zero. The exact guide I wish I had when I first started. And if you stick with me for the next 30 minutes, it could change the way you play this game forever. I'm not only going to show you how to avoid the 6-figure mistakes that I made, but more importantly, I'll show you the exact playbook I've refined over the years to turn crypto investments into real, lasting wealth without losing it all in the next crash. This is everything I know. I'm not holding anything back. The only thing I'd ask of you, if this video is or was of any help to you, please feel free to leave a like, a comment, or subscribe. It seriously boosts the algo and helps more people find it. Plus, much more content is coming very soon. Of course, I'll be replying to as many questions in the comments as I can, but if I miss anything, if I miss yours, you can also ask Plu, the AI assistant at console.pluit.com, a free crypto research tool I've helped build over the past 2 years. One of the best there is, I promise. All right, all disclaimers out of the way. This is 100% educational and not financial advice. But everything I'm about to show you only works if you can resist the psychological warfare that crypto puts you through. And I promise the market will test your absolute limits. So let's start with the brutal truth that no one talks about. Here's what happens to most people in their first year. They start buying a token they've seen on social media, they make some money, they might even turn their initial investment into 6 figures. But most likely, they will write their 6 figures back down to 5 again, maybe end up losing it all. And I was the same. In my first year, I kept buying what influencers were shilling, made some insane gains, and then I started losing. Of course, I sold nothing. I held on to everything. I kept telling myself, I just need to pick better coins with better fundamentals or better projects. But then I discovered something that changed my entire strategy and mindset. The vast majority of crypto investors don't just lose money, they underperform Bitcoin by 3 to 5% annually. Think about that for a second. While Bitcoin is up 160%, year over year, the average person in crypto is actually losing money. And I was one of those people. So the question isn't if the free market works, it's whether we can avoid the psychological traps that destroy everyone else. Because here's the thing. The people who do make money in crypto, they don't just make money, they make life-changing money. We're talking about turning $1,000 into 10,000, 10,000 into 100,000, and eventually 100,000 into millions. And these aren't fairy tales. I've seen it happen myself and I've witnessed it multiple times. Contrary to belief, this isn't a game of luck. In fact, winning in crypto has nothing to do with luck at all. It has everything to do with persistence, education, discipline, and strategy. So to play this game and win, you need to understand the rules, because crypto isn't just a list of tokens, it's an ecosystem, a hierarchy, and a battlefield. So if you don't know where each piece fits, you're basically just gambling. Think of crypto like a kingdom divided into 4 layers of power, or better yet, like a chessboard. At the top, we have the king, that's Bitcoin. Below that, we have the queen, Ethereum. Then we have stablecoins, our rooks, and at the bottom we have altcoins, meme coins and experimental stuff, our pawns, bishops, and knights. And here's why this matters more than you think. Crypto is a giant player versus player game. Always keep that in mind. For you to win, someone else must lose. And our main goal is to stay in the game as long as possible. The longer we are able to play, the bigger our gains will be. If there's just one thing I want you to take away from this video, it's that. Time in the market is much, much more important than timing a market. And there's one asset that does it better than anything else, our king, Bitcoin. Now, unlike all other cryptocurrencies, Bitcoin competes against money. If you will, it's digital gold. Slow, boring, and designed that way. Its movement is just as limited as the king's movement, but it does one thing better than anything else, it keeps the game going. Bitcoin stores our economic energy in a way that no government, no entity, and no third party can control. Ethereum, our queen, is where things get a little more interesting. Don't think of Ethereum as money, think of it as a global computer running smart contracts, a tech and innovation play. And as it is for the game of chess, the queen can move pretty much anywhere, right? Its utility is limitless, but the game continues even if the queen isn't on the board. In simple terms, Ethereum is the platform that enables the App Store and all of the applications, just in a decentralized way. Users partially own the network, users partially own the applications, and some of these applications also hand out tokens as a reward, called airdrops. Most of these qualify as altcoins, are bishops, pawns, and knights. Early altcoins tried to compete against Bitcoin. Of course, this didn't work out. And these days, altcoins are much more likely to compete against Ethereum. And this likely won't work out as well, because without Ethereum, most of them simply wouldn't exist. But the ones that are not trying to compete, the ones that are trying to solve specific problems instead, they are the ones that deliver life-changing returns. And lastly, our line of defense, stablecoins, the towers and rooks. If things go south, this is exactly what we need most. And here's how most people completely blow up their portfolios. They think diversification means scattering money across 100 different altcoins, hoping that one will move. But all they're doing is filling their board with pawns, bishops, and knights, and getting checkmated before the game even begins, because they simply never started playing. And it's for the same reason that so many people obsess over the one metric that makes the least sense in crypto: price. Pop quiz. I'm showing you two cryptocurrencies on screen right now. Tell me which one is more expensive. If you said coin B, you just made the number one mistake that destroys most portfolios. Of course, this was a trick question because price means absolutely nothing without context. Let me show you what really matters. Coin A, Shiba Inu, has 589 trillion tokens in circulation. At 0.0000135 cents each, that's a $8 billion market cap. Coin B, Render, has 532 million tokens in circulation. At $3.90, that's a $2 billion market cap. So Shiba Inu is 4 times more expensive, even though one token costs a fraction of a penny. This is called unit bias, and it's the first wealth killer most people fall into. Therefore, always, and I mean always, pay attention to the market cap first. Market cap equals token price times circulating supply, one of the most important rules in crypto. And now that you understand why the token price doesn't matter, let me tell you what you should actually be buying first. Stablecoins. I know this isn't what you expected, but I'm keeping it real with you. Stablecoins are absolutely critical for several reasons. USDC, USDT.D, and others are cryptocurrencies pegged to the US dollar. They're all worth $1 each and designed to stay there. Now you're probably thinking, why would I want a crypto stablecoin that doesn't go up? I've already got my fiat currency for that. Well, honestly, stablecoins are one of the biggest unlocks in the entire landscape of crypto. Here's why. Reason number one. They are your bear market survival. Stablecoins are there for you when the market crashes, and it will crash. Bear markets are long and brutal. The rooks are your line of defense, they're your insurance policy and your way to preserve value when everything else is bleeding red. It's a big misconception to think that only bull markets expand your wealth. Ideally, we should always position ourselves for the opposite market structure. So right now, we are clearly in a bull market, positioning ourselves for the bear. Again, our main priority is to play the game as long as possible, not to go out on a quick bang. Reason number two. As soon as you hold stablecoins, you enter the world of decentralized finance. This means you can now earn anywhere from 3 to 15% APY through various DeFi protocols, exchanges, and platforms. Essentially, you have skin in the game without risking anything, but the world of decentralized finance is now accessible to you. Compare the average 8% APY to your savings account, giving you 0.5%, and you'll understand why crypto people dislike traditional banks. Like, it's honestly wild. Now, this isn't 100% risk-free, please keep that in mind. Same with legacy banks, we never want to store all of our cash at one bank should it implode. That said, if you want to dive into earning yield and don't know where to start, I'll link a video for you up here or up here. And reason number three, when the market crashes 30% overnight and we witness a black swan event, you want cash ready to buy that dip immediately. If your money is sitting in a bank account, it can take days to transfer to an exchange. By the time it arrives, the dip has been bought and your opportunity is gone. When Bitcoin crashed to 4K in 2020, loads of people were sidelined because their money simply didn't arrive on time. You don't want to be this person. If you're holding stablecoins, you can seize those opportunities immediately. No waiting, no missed opportunities, no missed chances. So think of stablecoins as your home base, a place to park money that won't disappear overnight but still stays within the crypto ecosystem, earning yield and ready to deploy at moment's notice. Plus, you have skin in the game without risking anything. The best first buy is always going to be our defense, our rooks. Okay, that out of the way, here's how I think of the ideal portfolio allocation. At least 50% Bitcoin. Your king, your foundation, what keeps the game going. 20% Ethereum. Your queen, the innovation play. More options, but the game continues without her. 20% stablecoins. Rooks are hugely important for the reasons I just mentioned. And lastly, 10% in carefully selected altcoins. We're going to talk about those later in the video. That said, I'm a little more extreme. I tend to keep my Bitcoin allocation above 80%. The rest is pretty much all tied between ETH, stablecoins, and just a few carefully selected altcoins. But even the perfect portfolio means absolutely nothing if your timing is off. Because let's face it, in the world of crypto, timing isn't just important, it's everything. And this is where even some of the most seasoned investors still get wrecked. Every 4 years, something happens in Bitcoin's code that creates millionaires. And most people have no idea it's coming or how to take advantage of it. It's called the halving, and it's written into Bitcoin's code, into its DNA. And this doesn't just affect Bitcoin, it affects the entire crypto market. Every 210,000 blocks, or roughly every 4 years, the block rewards, meaning the number of Bitcoin miners get rewarded with, gets cut in half. Of course, Bitcoin will reprice itself. It's simply economics. Germany has an energy shortage, which is why energy prices have been skyrocketing. Bitcoin follows a similar path, but this shortage is programmed, predictable, and we can absolutely take full advantage of it. Now, here's the important part. The real bull run starts 12 to 18 months after each halving. So in 2012, Bitcoin went from $12 to $1,200. In 2016, Bitcoin went from $650 to $20,000. In 2020, Bitcoin went from $8,000 to $69,000. And the most recent halving was in April 2024, which means if the pattern holds, we should see the peak between now and early 2026. So we are now entering the window where the biggest gains are being made, but not by simply buying everything. It's about knowing exactly where the liquidity is heading next and positioning ourselves before it arrives. Because in crypto, money doesn't just appear randomly. It rotates from king to queen to pawns to rooks and back again. The key to all of crypto is mastering the idea of cycles and liquidity rotation. This allows us to position ourselves before the liquidity arrives, which results in the biggest gains. And as I just mentioned, money in crypto moves in a very predictable pattern. Think of the kingdom layer again. Bitcoin first. This is where most of the liquidity sits for most of the time. Then the liquidity starts to rotate into Ethereum, the innovation layer. Then into altcoins, the tokens coming out of the innovation layer. Then meme coins, NFTs, and experimental stuff. When people made money, they start gambling, which is a clear signal for us to start taking profits. Which brings us back to stablecoins, going full circle. This is where the liquidity goes last. So before we buy Bitcoin, Ethereum, or altcoins, we have to figure out at what point we're entering the cycle and where the liquidity will rotate next. To understand this, we will use one indicator and a couple of charts. I want to keep this as simple as possible so you can follow those steps at any time at your own convenience. All you need is TradingView. It's entirely for free, the best charting tool there is, and it's linked in the description. After opening TradingView, we will add our main indicator called RSI, which means Relative Strength Index. Sounds super complicated, I know, but it's actually very simple. The higher the RSI, the more overbought an asset is. The lower the RSI, the more oversold it is. A divergence happens when the chart moves one way, but RSI moves in the other. That's a warning sign that the overall trend might reverse. And the great part, we will simply apply this indicator to all of the following charts. Number 1, the Bitcoin dominance chart. This shows us exactly what it says, how dominant Bitcoin is compared to the rest of the crypto market. Number 2, the Ethereum dominance chart. Same here. This shows us how dominant Ethereum is compared to the rest of the market. Then the total 3 chart. This chart shows all crypto assets except Bitcoin and Ethereum, meaning we get a good idea if we're about to experience alt season. And finally, the US dollar index, also known as the DXY. This chart shows the strength of the US dollar compared to all other major currencies. It basically represents our stablecoins. The weaker the US dollar, the better for stocks, assets, and crypto. But if the DXY is oversold, it's a clear signal for us to stay cautious. And here's the key. We will only look at the RSI on the daily, weekly, and monthly timeframes, because the higher the time frame, the greater the impact. And before we buy anything, which I will talk about in the next section, we wait for pullbacks, because usually liquidity only rotates during dips. Of course, it's also vital to pay attention to legacy markets, like if the Nasdaq crashes, if something bad happens to the macro landscape, or if new tariffs are announced, crypto will be the first place where liquidity moves out of, because this market and this game is the most efficient, period. Unlike stocks or banks, it's open 24/7, 365 days a year. Knowing how to spot the rotation is the first hugely important step, but if we don't know how to buy smart, we get nothing for our knowledge. And this is the only time where we actually need to pay attention to prices. So most people see a coin pumping, FOMO in at the top, watch it dump, panic sell at the bottom, and never touch crypto again. Because they buy at the wrong time, without knowing what to expect, without knowing how the liquidity rotation works, and with their emotions all over the place. But we have already established that liquidity is always rotating, and you already know what to look out for. So this is not going to happen to you. Therefore, I'm going to show you two strategies that remove emotion completely. And we will use those strategies in combination with one legendary tool and the charts plus the RSI from just now. Strategy 1, dollar cost averaging. Now, this strategy needs no introduction. Quite honestly, you don't even need to pay attention to the liquidity rotation, because this is about accumulation, mainly one or two assets that you want to own more of. So instead of trying to time the market and find the best entries, we simply buy a fixed amount every week or every month. But this only works if we stick to it religiously. And after a full cycle, meaning after 4 years, if you invested in Bitcoin as an example, from mid-2021 all the way to 2025, you'd have invested a total of $4,800. With Bitcoin's growth and your average entry price, your holdings would be worth $12,000 right now, roughly a 2.5x return. Not bad, right? So for anyone getting started, I highly recommend dollar cost averaging, because it's the easiest to set up and removes psychological stress entirely. Strategy 2, the ladder method. This strategy focuses on buying the dips. But here's the problem. Most people don't know how to differentiate a good dip from a falling knife. They buy the dip and it just keeps dipping, and ultimately they become the famous meme. So we will only apply this strategy if the charts, the RSI, and this one legendary tool confirm our bias. Now, to predict how deep corrections go, we will use our one legendary tool called Fibonacci retracement. It's basically a cheat code on how to find good buy zones. And all we need to identify before using this tool is a clear swing low and a swing high. So we look at our chart and find a point where price clearly went up a lot. The lowest point before that big move is the swing low. The highest point it reached before turning back down is the swing high. Most corrections pull back to the 0.618 level, also known as the golden ratio, sometimes a little lower, but usually that's a very good spot for entries. So let's say we want to position ourselves to buy Ethereum. Firstly, we have to make sure that Bitcoin dominance is topping out, because only then we will know that Ethereum will have its moment to shine. Secondly, we will look at the Ethereum dominance to confirm this bias. And Ethereum is currently on a very nice run. So we have two options. If the ETH dominance chart looks too toppy, too overbought, we can also skip Ethereum entirely and focus on buying altcoins instead, because this is where the liquidity is headed next. But if we assume that Ethereum will at least break all-time high before alts go on a run, we should ideally position ourselves for this scenario. So to check how altcoins are performing, we simply take a look at the RSI on the total 3 chart. We confirm that the rotation into altcoins has not quite begun yet, and of course, the DXY shouldn't be completely oversold. If all of these conditions are met, we can start setting up buy orders at different price levels. So if you wanted to invest 10K into Ethereum, ideally it would look like this. $3,333 at the 0.786 level, $3,333 at the 0.618 level, and $3,333 at the 0.5 level. So we have spare powder in case the dip keeps dipping and we don't become the meme. In theory, if all of these targets are hit, you bought Ethereum at a really, really nice discount. Fear is the only emotion we need to master. Either the fear of losing too much or the fear of missing out. We buy the FUD, we sell the FOMO. If it feels terrible, it's usually the best time to buy. And while this sounds rather simple, the hardest part, the real challenge, is knowing when to sell. This is where most people completely destroy themselves. They hold through an entire cycle without taking profits, they sit on 1000% gains, and then they panic sell at a 50% loss. But that's okay, it happens to everyone, myself included. So let us simply fix this once and for all. You can't make money if you never take profits, right? But you also can't time the exact top. That's pretty much impossible. Therefore, it's completely subjective at what point your personal level is met. For some, 10K would be life-changing. For others, it's 100K or 1 million. The most important rule when taking profits is to never compare yourself to others. You're not selling for their circumstances, you're selling for yours. And this time, the emotion we need to control is greed. For me personally, the best psychological greed indicator is the screenshot method. If my portfolio is reaching new all-time highs and I have the urge to take a screenshot, I sell 20% right then and there. So if you feel the urge to take a screenshot, take the screenshot, but also take some profits off the table. Your own emotions are likely telling you, yo, this is crazy, bro, we're getting rich. And that's exactly when your subjective level is hit. The ladder exit strategy. Now, this strategy removes emotion entirely and focuses on data. Just like we used Fibonacci retracements to ladder into positions, we can use Fibonacci extensions to ladder out. Think of it like this. Retracements are where price pulls back to buy, and extensions are where price pushes into so we can sell. Same as before, we only have to identify the lowest point before the rally started, the swing low, and then we find the highest point and reach before pulling back to give us a higher low, the swing high. Now look at the numbers above 1. If TradingView doesn't display them automatically, simply press right-click on the chart, head over to settings and include the following profit-taking zones. 1.272, this is our first take profit zone. 1.618, the golden breakout target, our second. And 2, the common cycle peak, our third. The key is to set these levels before the rally takes off. This stops you from moving the goalpost when things get euphoric and greed starts taking over again. So at this point, you've recovered your initial investment and locked in some gains. Now, I personally always take 20% and rotate those profits into our defense, into the rooks, into our stablecoins, just so I can position myself for the bear market while earning yield. This move ensures that I stay in the game no matter what, as this is my only and biggest priority. That leaves us with the final 40%, your hodl back. You can either let it ride without stress, knowing you already secured profits, or you can exit the entire position. And this is a topic for another time, but please don't ignore taxes. Every country has different rules, but in most cases, crypto profits are treated as capital gains. To be safe, make sure to set aside at least 25%. The last thing you want is to win big only to get wrecked by taxes. Most importantly, greed has destroyed more crypto fortunes than any market crash ever will. But then there's also one thing we need to talk about before it comes to altcoins, and this mistake can destroy your gains even faster than greed. It's completely 100% avoidable, and if it happens, it's entirely your fault. I'll keep this section short because I've got an entire video coming up that explains everything in great detail. You only need to understand the following. No exchange is 100% safe. If they go down, your money goes down with them. Please take this serious. It's literally one of the most overlooked aspects, not just for beginners. Not your keys, not your coins isn't just crypto slang, it's 1,000,000,000% true. So here's what I recommend. Step 1, set up your wallets as soon as possible. At least download a free wallet, either in the App Store, Play Store, or as a Chrome extension. Now, I'd suggest Phantom or Revy for Ethereum and most other coins, and Xverse for Bitcoin. And for serious money, if you're investing more than 10K, please get a hardware wallet immediately. For most people, Ledger or Trezor are the most straightforward options. They are user-friendly and support tons and tons of cryptocurrencies. But for Bitcoin maxis, like if you only want Bitcoin, I highly recommend using Coldcard. In my opinion, there's nothing better on the market right now. And please don't buy them off Amazon or secondhand. You need to be sure that they have not been tampered with. I'll link all the official sites in the description. The bottom line is this: your crypto security is entirely in your hands. That's the beautiful and the terrifying part. We own our funds in a way not possible before crypto. Exchanges are for buying and selling, not for storing. How you store your coins, that's completely up to you. Okay, that out of the way, let's talk about altcoins, how to actually research them properly, and how to spot early metas. A key concept in crypto evolves around understanding early metas. If you come from the gaming world, the word meta shouldn't be a new term for you. But to anyone else, if we apply the term meta to chess again, it's basically a new opening move that destroys your opponent. And of course, because it works very well, in a couple of months' time, the entire chess community will likely start using it. By then, it's time to move on to find a new opening move or a new meta, simply because this one won't work anymore. Metas are mostly found on crypto Twitter, also known as CT, and there have been countless metas. We had the ICO meta, the DeFi meta, the NFT meta, the gaming meta, the meme coin meta, the ordinals meta, the tokenized stock meta, and so on. If you pay attention to new metas and position yourself before they explode, before the entire chess community starts using them, that's a very good way of making insane gains. So if you aren't on X, I highly suggest creating an account. I've linked a thread of mine in the description which lays out incredible profiles to follow that will bring you up to speed in different sectors, focusing on different projects, metas, and narratives. Now, besides spotting metas, doing your own research isn't just crypto slang, it's survival, especially when it comes to altcoins. Never, let me repeat that, never buy coins based on Twitter hype, some influencers telling you what to buy and without doing your own research. We will keep this section focused because I will not tell you what coins to buy. If you want a detailed tier list of all current altcoins, I'll link a video up here. But in this guide, I'll show you what's more important, and that's how to spot good altcoins from bad altcoins and how to avoid disasters. Step 1. Check the tokenomics. Go to CoinGecko or CoinMarketCap, look at the circulating supply versus total supply, understand the token unlock schedule, and calculate if the FDV, the fully diluted valuation, makes sense. Step 2. Check the team. Are they doxed? Are their identities public? If they are anonymous, it's much easier to disappear if things go wrong. So regardless if they're doxed or not, what's their track record? Have they built successful projects before? Have they built anything before? Step 3. Read the white paper. I know this one seems obvious, but I'm always surprised by how many people don't truly know what they're buying. Does the project solve a real problem? If not, why are you buying it? Is the technology actually innovative or just hype-driven? Is there a real revenue-generating business behind this token? You might think this is the case for all of them, but this is only true for the overwhelming minority. Step 4. Check the community. Are there real active users, not just some AI bots? Scan the Discords, the socials. What are they saying? What's the overall sentiment? If the majority of voices feel like AI, stay away. Step 5. Use professional tools. If you want to dive deep, I only use 4 platforms: console.fluid.com, and I'm not biased, it's quite literally the best research platform in crypto. That's just how it is. Hundreds of articles to check out, and if there's anything you don't know, you can simply ask Plu. DeFi Llama or Dune Analytics for statistics, charts, and protocol metrics, and finally Messari for comprehensive data. In short, if the altcoin sounds too good to be true, it usually is. If you can spot one red flag, there's likely a second one buried a little deeper, and if there's no real product or real utility, you're most likely buying a meme coin. And now to the most important question of this entire video. Is it too late to get into crypto? That's the question I get more than any other. So let me answer that question with a question. Was it too late to buy Apple in 2010? The iPhone had already been out for like 3 years. Apple was worth over $300 billion. If you had bought Apple in 2010, you'd be up over 1,000% today. So short answer, no, it's never too late to start preserving your wealth. There are 2 tools I use frequently to remind me of the bigger picture. The first is the M2 money supply. M2 is the total amount of money circulating in the US economy. Cash, checking accounts, savings, and short-term deposits. Okay, so why does this matter? Because it tells you exactly how much money is entering or leaving the system. If M2 is rising fast, the Fed is injecting liquidity. If it's flat or falling, liquidity is drying up, which means we are in a risk-off environment. And here's why it matters. Crypto thrives in high liquidity environments. When there's too much money chasing too few assets, people look beyond cash. That's when capital flows into risk-on markets like crypto. And as you can see, this chart, the M2 chart, has no ceiling. It's up only. And the second tool is the US Debt Clock. This is a live dashboard that shows just how deep the rabbit hole really goes and how fast we're digging it. You can also check it yourself at usdebtclock.org, linked in the description. It tracks national debt, debt per citizen, government spending, budget deficits, and unfunded liabilities like Social Security. And right now, the US is $38 trillion in debt and rising. And the scary part, there's no real plan to ever pay that back. So what happens when governments can't repay their debt? They inflate it away, printing more money, devaluing your savings, and making every dollar you hold worth less. But the much bigger problem, and what most people don't understand, is this. Inflation is not only destroying your purchasing power, it's also stealing your time. Essentially, we're all trading our time for money. And if $20 buys us less next year, the hour we worked for that $20 is worth less too. It's like saving a battery that slowly drains. Inflation drains our time battery, so we have to work more later to buy the same thing, which is a very unfair trade. This is why Bitcoin was created in the first place. This is Satoshi's gift to us. It's not just about cypherpunks being cool. Bitcoin is a hedge against irresponsible monetary policy. It's a solution against inflation. It's a way for us to protect our time and purchasing power. And let me quickly add this. Thousands of crash prophets have been preaching about the great crash forever. It's coming next week, next month. It's around the corner. It's almost here. Most of them fail to see that we've been crashing upwards. Everything is at or around all-time highs. Stocks, real estate, Bitcoin, gold. But our everyday life is getting more and more expensive. Welcome to the great crash. We're currently living in it. We're just crashing upwards. So ultimately, no, it's not too late to get started. You're just on time.